Hi everyone, it's Chap out with another video. Today I'm going to be talking about Visa. Just announced earnings as the market closed today, and on the futures market it's about flat basically in the after hours. So tepid response to this, but for relatively decent earnings in my opinion. Stock again lukewarm this year, down 4% year to date, but that is far less than the S&P 500 and the Nasdaq are down, both down greater than 20%. It's a decent way off its 52-week high of $252, but still done pretty much nothing this year, which means it's been a pretty good stock to own in a market where everything's down 20%. I'm going to talk about the earnings, I'm going to talk about its valuation, its balance sheet, its margins, do a DCF and decide whether I think this company's a buy in the future and going forward. In the face of a really tough macroeconomic environment, a lot of uncertainty, a lot of headwinds in terms of exchange rate, and of course the suspension of the business in Russia, Visa delivered a very, very strong quarter in my opinion. Net revenues of $7.3 billion, that's a 19% change year over year. GAAP net income, $3.4 billion, 32% year over year. Earnings per share up 36% year over year for $1.60. The key business drivers here was quite clearly the cross-border volume, up 48% year over year, excluding intra-Europe, and up 40% overall. Processed transactions up 16% and payments volume up 12%. Overall, an absolutely excellent quarter. They returned $3.3 billion of capital to shareholders in the forms of repurchases and dividends. And I can't stress this enough, in the midst of a really tough environment, I think this is a really positive sign for the wider economy and for consumer sentiment. Digging a bit deeper into those revenues, of the four main values, data processing revenues is the largest at $3.5 billion, up just 8%. That was the lowest increase, but again, a massive scale. Service revenues is the second largest. That was up 13% year over year for just shy of $3.2 billion. International transaction revenues up a whopping 51% to now $2.56 billion, and the other revenue segment up 26% to $517 million. This was for a total gross revenue of $9.845 billion, up 19% year over year, but you must subtract the client incentives as part of this. That was up 21% year over year, slightly higher than the revenue increase, and that was $2.5 billion or just above. That gave net revenue, which increased 19% year over year, of $7.275 billion. One possible problem that looks to be on the horizon is the processed transaction revenue growth looks to be tailing off on the right hand side of this graph. From May to July, it's significantly down, so I'd say it's in the 14 to 15% range. Compare that to where it was in the end of 2021, the July to January period. That was well over 20% the whole time. It's been steadily declining for pretty much the last year. In April, May last year, that huge increase is well over 50% processed transactions revenue growth. It's mostly to do with the stimulus checks. This is when the first stimulus checks was given. So it's completely understandable why this revenue was so large. It's because people were spending like there's no tomorrow. Transaction revenue went up very quickly in a very short amount of time and roughly returned to normal straight after. But 20% growth across the board led it towards the back end of last year, and going into the back end of this year, it looks like that's going to be around 12 to 15%, which is a significant deceleration. Of course, we're in a tougher macroeconomic environment, but you'd imagine because of inflation that the transaction revenue would be increasing, so this is slightly worrying. Before I get into valuation and things like that, I just want to talk about this company's returning cash shareholder policy. In the last 3 months, it repurchased 12.2 million shares of Class A common stock, an average price around $202 for $2.5 billion. That's $2.5 billion returned to shareholders in the repurchases. And in the last 9 months, ending at the end of the second quarter, they'd repurchased 45.4 million shares at an average cost of $207, which is not much cheaper than where it is today. So clearly management thinks this is an attractive valuation for the company, using $9.5 billion of cash. So in a minute, this is going to explain why they don't carry a ton of cash on the balance sheet. They have a further $7.2 billion of remaining authorised funds for share repurchases, which I'm sure they will continue to do because the price hasn't really done anything since then. Not to mention, they also pay a dividend, not a particularly high one. It's 0.7% yield on a forward basis, 0.1% growth rate over the last 5 years. This is at a tiny payout ratio, a dividend payout ratio of 0.22, but again, they put a lot of their cash flow to use on share repurchases. Overall, they're returning a lot of cash to shareholders. It's just not all in the form of dividend, which in a way Not so good for income investors, but it is growing quite a lot in the last 12 years. It's more than 10x. So there is that to consider. It's never going to be an enormous number, in my opinion, but they return a lot of cash to shareholders in the form of repurchases, which is a much more tax-effective way, and is something that I prefer, but not everyone prefers that. As I mentioned, they don't carry too much cash on the balance sheet, so a 0.64 cash to debt ratio. Currently, they've got around $14 billion in cash, around $20 billion in debt. We'll get into why that isn't such a problem when we talk about the margins, but I'm not overall concerned about this. They're very free cash flow generative. They continue to repurchase shares, pay a dividend at decent payout ratios. I'm not concerned about this at all. $20 billion on a $400 billion company is not a lot of debt at all. It's also very low interest debt. 34.55 interest coverage means that they can pay off 34.5 years of interest using this year's EBIT alone. This combined with a relative low debt number and a decent debt to equity, debt to EBITDA, gives an Altman score of 7.33, indicating that this company is safe from immediate term financial distress. Now, looking at the margin profile, this company is truly best in class. Gross margin of 80.5%. You will very, very rarely see a company that has a higher gross margin than that, and if it is, it's almost certainly a SaaS company. And this isn't even that good for Visa's history. This is on the lower end of what is typically expected, but it's almost always above 80%, which is incredibly strong. Operating margin of 67%. I cannot speak highly enough of how well they translate gross margin to operating margin. That is an unheard of translation down. 67% operating margin. Very, very strong for Visa's history, so they're continuing to squeeze more out of that gross margin. And a 51% net margin, meaning they take home 51 cents for every dollar of revenue. That's straight in earnings, essentially. Truly, truly outstanding numbers. Best in class. Only really MasterCard that competes, particularly this size and scale. Of course, SaaS companies have ludicrous gross margins, but in other companies in the rest of the world, no one is competing with Visa and MasterCard. Return on equity percentage of 37. Again, some of the best you'll see at this size and scale. I typically expect between 10 and 20%. 20% will be a fantastic company. 37% is a truly, truly excellent company. Return on assets percentage, I typically expect between 5 and 15%. This company's returning nearly 17. Excellent. And return on invested capital, I love anything that returns above 20% here. 21%. Absolutely excellent. All these numbers, you can see Guru Focus is giving it dark green. That's meaning that they're some of the highest and best metrics versus its industry and versus history. That just shows how consistently management is performing and how it's got this business ticking over at an excellent rate. Now, when you grow at nearly 20% a year, you have a very strong balance sheet and an unbelievable margin profile. You will get attention and your valuation will befit that. And that is no exception here. It has a 33 PE ratio on a trailing basis, on a forward basis, PE of 25, both far above the S&P 500 averages right now. Even though a PE of 25 for a company of this quality, I would not say is grossly expensive. There is still a premium to be paid here for a company of this quality. Price to earnings growth ratio of 2.32. This is far above what I would consider a bargain. I would consider below 1 to be cheap. This is clearly not cheap on a PEG ratio basis. 2.32 is not really the type of number I'll be looking for here. Price free cash flow, another metric that I typically like to be below 20. Price free cash flow of 30 here. That is very high. Well, it's not very high, but it's high. Much like the PE ratio, this is far above the S&P 500 averages, but is kind of to be expected for a company that is at this sort of premium. And Visa really has never been below, in my memory, over the last 10 years or so, never really traded at very high discounts to either of these. Finally, here is my discounted cash flow analysis. Over the last 10 years, Visa has averaged 18.8% free cash flow growth. This is a fantastic compound annual growth rate of free cash flow. I'm not sure they can continue it going forward. Revenue has been more like 13.3%. They're already squeezing a lot of their gross margins. I'm not sure they can get it any higher. I'm not sure, given the economic uncertainty going forward at a higher interest rate environment, I'm not sure 18.8% free cash flow growth is achievable going forward. If you believe that it is, then this is a company that is trading at a discount to its intrinsic valuation. This is just not what I believe to be the case. I think free cash flow could possibly grow in line with revenue, and I believe the 13.3% revenue growth that it's averaged over the last 10 years is about right for this company and what it can do in the next 10 years going forward. And in the last 5 years, it's gone up 11.2%, has a really strong market position in an effective duopoly. I believe it can continue to perform at this rate. If you use a 13.3% growth rate for free cash flow for the next 10 years and a 4% terminal stage growth with a 9% discount rate for the stock market, this gives a fair valuation of $168 compared to a present day stock price of around $212, meaning that this is just not really an investable company on a discounted cash flow basis. Compared to its fair value, it's a significant premium. Now, there is a premium that I will be willing to pay for this company, perhaps above fair value, but this just isn't it. I have owned Visa stock in the past, and I bought valuations like this, 168 when it was down there, 140, and I sold when I thought it got a bit frothy. I'll be much happier owning this company when it gets in the if it gets to the 150, 160 range where I believe its fair value lies. I just don't really believe that it can be pushing its free cash flow in the 20% range. However, that's just my opinion. I've spoke a lot about how fantastic this company is and how well it's performing, so you should form your own opinions based off that, looking at the earnings report yourself, doing your own due diligence. I'm, of course, not a financial advisor. This is purely my opinion. Like and subscribe if you're enjoying the videos. Comment down below what you think about this company's quarter, what it means to the wider economy. If you think Visa's a buy, sell or a hold, I'll be interested to see what you say. Of course, a little bit of Discord in the comments. I'll see you again next time.